Robotic process automation company UiPath reported earnings last night, and the market likes what it sees, sending it up about 5% in pre-market trading. So what does this mean for investors and what should we look for moving forward? My name is Brian Stoffel. As of the time of this recording, I do not own shares of UiPath, although I have been a shareholder in the past. And I want to give a shout out to YCharts for sponsoring today's video. More from them in just a minute. So this was the second quarter of fiscal 2024. I know that's a bit confusing, but 2024 that ended July 31st. After today's bump, UiPath will be worth around $9.5 billion. On the top line, revenue grew 19% to $287 million. That beat Wall Street's estimates and management's guidance. And on the bottom line, the company earned 9 cents per share on a non-GAAP basis. That beat estimates. It's also worth noting management guided for $10 million in non-GAAP operating income. They tripled that, so that is a very solid beat there. In terms of what the company saw during the quarter, management said that the cohort of customers who spend $100,000 or more in ARR is performing very well. In other words, large customers are performing well. Value selling is driving platform adoption, and these deals are typically expansions where they have a good line of sight into the deal progression. The lower end of the market has been harder to call, particularly new customers. Now, this is a theme that we've heard a whole bunch where smaller companies are pulling back on things. UiPath, what they offer, robotic process information, basically makes it so that AI can do a whole bunch of things behind the scenes for you before you need to. Things like picking out details in an email or workflow automation. So it's not terribly surprising to see that these low-end customers are somewhat falling off a little bit. Now, if we look at the company's gross margins, these are all on a non-GAAP basis, there is a lot to like. Gross margins expanded to 86%. Operating margins went from a loss to a meaningful gain, and the same thing happened with net margins. Free cash flow went from a loss to a gain, as did net income, and this balance sheet is in absolutely pristine shape with $1.8 billion in cash and that's right, zero debt. Now, we saw a whole bunch of stuff about non-GAAP figures. Why? Well, a big part of it is stock-based compensation. Over the past six months, the company has given away an equivalent of $187 in stock-based compensation. That's about a third of the revenue over the last 6 months. One good thing is that the dilution, it was just, I put that in air quotes, 3.1%. That's still higher than we'd like to see, but because the stock is somewhat well valued, it pushes dilution down so that it's not higher than that 3.1% threshold. Now, this is something that shareholders should know and get used to. Since the company came public, shares outstanding have continually increased. 10.5% now. If the company continues to execute, that shouldn't be a problem. But if they hit some obstacles, it could be. Now, on that note, it is worth mentioning that the company's board of directors has authorized the $500 million share repurchase program that's equivalent to about 5% of today's market cap, give or take. So that could have a meaningful effect at the very least on dilution. Now let's go down the income statement, because if you remember, this is a company that is in the middle of a transition, and it's important to talk about this. Typically, UiPath offered licenses where one-off purchases to on-premise servers for a company where they could run UiPath's tools in the background. That is very high margin. However, it is not the way of the future, which is in the cloud. In other words, not putting it on someone else's servers, but hosting it on their own servers or via the public cloud companies with their technology. Now, because of that, there's a bit of a transition going on, which makes things a little bit wonky. So these licenses is kind of like the old guard. Revenue there was up 15%. Subscription was up 28%. That's kind of the new guard. If we look at gross margins, what we see here is that licenses, the cost of it increased more, but look at these gross margins for this licensing business is obscene. I almost never seen anything like it. So that bump up is not that big of a deal. What's more important is that subscription services revenue grew 28%, while the cost of that revenue just grew 20%. We don't really pay too much attention to professional services and other because it's kind of a loss leader. But really what happened is overall revenue was up 19%, but gross profit was up 20%. That means that this company does have operating leverage working in its favor right now. And that same thing continues when we look at operating expenses. Look at this. Operating expenses actually fell from the year ago quarter. This is on a GAAP basis, but that is rather significant, and it's what leads to this operating loss being cut by 35%. Again, that includes stock-based compensation, so on the free cash flow basis, it was even better. Now, in terms of other news for the company, the number of customers with spending at least $100,000 per year was up 16% year over year. Those spending at least $1 million was up 34% year over year to 254 customers. ARR, which is annual recurring revenue, in other words, revenue that the company, as long as it has a moat, should be able to count on, grew 25% year over year. We'll talk more about that moat in just a minute. So as we said, 25% ARR growth. Cloud ARR growth was 125%. So they're getting more people to sign up for the cloud versus licensing. That's a very good sign. Dollar-based net retention rate was 121%. It would have been 125% if not for foreign currency fluctuations. Let's talk about what that means. If you take all the customers that UiPath had in the year ago quarter and said, how much did just those customers, don't pay any attention to the new customers, just those customers, how much did they spend? They actually spent 25% more. So not only did they stay on board, but they spent 25% more. That lends itself to the idea of high switching costs, because the more you use UiPath's tools to complete certain tasks, the more onerous it could be to switch to a competing vendor. It's hard to say because we're in early days of these AI tools to know how high those switching costs really are. The company also said that remaining performance obligations were up 28% year over year. That's great because it is faster than revenue growth of roughly 20%. So we like to see that. And let's just check out where the company is in the rule of 40. That's revenue growth plus some other profitability margin. We use free cash flow. You can use different ones here. But revenue growth of 19%, free cash flow margin of 15% gives it a 34. So it's actually a little bit shy here. We are seeing some marked improvements in the free cash flow margin. What we're waiting to see is if this revenue growth can re-accelerate or if it's in a state of slow decline. Turning to guidance, management's guidance for 20% top line growth was roughly right in line with Wall Street. Management doesn't give an earnings per share guidance, but they say they expect to earn $32 million in non-GAAP operating income. That's double what it was last year. And for the full year, management bumped its full year guidance up ever so slightly, pretty much in line with Wall Street, both saying about 20% top line growth. Management saying that non-GAAP operating income will more than double to $188 million. What should investors watch moving forward? First, new customers. You heard management call out that those lower and smaller medium-sized businesses, they're having a tougher time getting traction there. Keep an eye on that. You'll just need to listen to commentary because they don't break that out. Keep an eye on the dollar-based net retention rate. Seeing that at 125% in this day and age is a very good sign. If they can keep it above 120%, that's great. Operating margins is next. Operating expenses actually shrunk. This company is showing that it can rein in costs while not having an outsized effect on that dollar-based net retention. That's huge. And free cash flow. The company is transitioning to being free cash flow positive. That's great. I think that the moat direction is stable, if not expanding. And since I'm no longer invested in the company, I don't want to say whether or not the thesis is on track because I don't have a particular thesis to speak of. But let's take a look at valuation. And for valuation, we have to say, well, what area is this company operating in? I would say stage 3. It might even be getting into stage 4 now. And for valuation, we're going to transition on over to Y-Charts. Today's episode is brought to you by Y-Charts, and the company has an exciting announcement. They just announced their latest product enhancement called Proposals. Y-Charts Proposals is a game-changing capability that empowers wealth management professionals with the prowess to craft captivating narratives effectively convey their strategy to help win new business. Now, that's not all. Mark your calendars for September 22nd because YCharts is hosting a webinar to unveil proposals and show off its full potential. You can learn more about it there. Click the link in the show notes below to register for the YCharts webinar, and you get 20% off your initial subscription when you start your free YCharts trial. All right, so we head on over to YCharts and we say, well, how can we value UiPath? Well, we could use the price to sales ratio at about 8. That is expensive on an absolute basis, but as you can see, it's about in line with where it's been for a year and definitely lower than where it's been since it came public not too long ago. We could look at gross profit because this company has great gross profit margins. If it's trading at about $9.5 billion, it has a price to gross profit ratio of about 10. Again, that's pretty expensive on an absolute basis. We could even look at, believe it or not, UiPath has a forward PE ratio. Now, this is just an estimate, but a forward PE ratio of 48 is not cheap, but it's also not ridiculously expensive either. So we can see that this company is growing into its ability to cut costs and show that it can be profitable. If we look at the price to free cash flow ratio coming into earnings yesterday, it was trading at 95 times free cash flow. However, with free cash flow expanding by about $75 million today, it trades at only about 56 times free cash flow. That's a pretty good deal. Now, we can also, for this, look at a reverse discounted cash flow model. And for that, we head on over to this tool that Brian Feroldi and I have constructed. We put the ticker symbol in here, which is PATH. Free cash flow over the trailing 12 months, I've calculated at $169 million. We will have a terminal growth rate of 2%, a discount rate of 10%, and we just have to make these numbers match now. Now, this is pre-opening of the markets, but basically if we get, let's see, 21, 22, and I'm guessing the stock is going to go up, so let's call it 23% growth every year for 10 years in UiPath's free cash flow, then it would be worth today's price. That's the growth that is factored in here. Is that worth it? Is it not? Well, when I think about it, I tend to put it here. I think that's actually fairly reasonable. Now, one of the reasons I say that is that the company's free cash flow margin is still over the trailing 12 months in the 10 to 15% range. I believe that could double, if not move up even higher moving forward. So that seems like a pretty reasonable valuation, all things considered. Now, the moat is the key. Is robotic process automation, is that truly something that would be difficult to switch over? Or could a company like Microsoft come in and really make it very easy to use the same tools and not create a headache for big organizations that are already using a whole bunch of UiPath stuff? It all comes down to a moat. And there are several ways to analyze a moat. One of the ways that's very popular is using Warren Buffett's rules of thumb. He has 14 rules of thumb where you can just look at the numbers and figure that out. Now, Brian Feroldi, Brian Withers, and I are hosting a webinar on Warren Buffett's rules of thumb. It is 100% free. It'll be on Thursday, September 14th at noon Eastern, and it will be recorded. So if you register and you aren't able to make it, we will send you a copy of the webinar as well. If you're interested in signing up for that, click the link in the show notes below. Overall, this was a pretty positive quarter for UiPath. It doesn't seem ridiculously expensive stock. And it's also worth saying that what they need to do is show that they can continue expanding within their large customers, see an uptick in those smaller customers, all while cutting costs. Those are good signs. We'll check back in on this one in 90 days. Until then, Brian.